I'm Steve, and today we're going to cut through all the noise. We're focusing on one single powerful concept: order blocks. Forget all the complicated indicators for a minute. We are going to learn how to read the chart and see the actual footprints the big institutions leave behind.
So let's just get right to it. Why do most retail traders lose? Well, the hard truth is they're playing a completely different game. They're reactive. They see the price rocketing up, and what do? They jump in, right at the top, because they're scared of missing out. Then they see it all collapsing and they panic sell, right at the bottom. They're always late to the party. And this slide really says it all, doesn't it? Look at the difference. The amateur is always chasing. The pro, they wait for the price to come to them. The amateur becomes the liquidity. Think about that. Their stop losses, their panic sells, that's what the big institutions use to fill their huge orders. The pro understands this. They don't fight the institutions, they ride their coattails. The whole point is to change your mindset from being the hunted to being the hunter. All right, so to trade with these guys, you first have to see where they've been. You have to learn to spot their footprint. See, they can't hide what they're doing. They're too big, and they leave clues all over the chart if you know what to look for. And this is the key. This is the footprint, an order block. You know, it's actually really simple. It's the last down candle before a huge move up, or the last up candle right before a huge move down. That zone, that's the exact spot where a bank or a hedge fund loaded their boat before they hit the launch button. I like to use this analogy. Think of it like a gas station. A big institution, they want to buy, say, 100,000 contracts, but they can't just slam that order in all at once, right? It would spike the price and give away their plan. So they get partially filled, the price takes off without them, and they've still got unfilled orders sitting there. They need the market to come back to that gas station so they can top off their tanks. Okay, so theory is one thing, but spotting these on a live chart in the heat of the moment, that's another. So let's break down exactly how you read these blocks, both the bullish and the bearish ones. For a bullish order block, you're hunting for one thing, that last moment of selling right before the buyers took over completely. You find that last red candle just before a massive, explosive green move. But here's the real clincher. You have to see displacement. The move away from that candle has to be fast and strong. It should leave absolutely no doubt about who's in control now. That little red candle, that's where they made their stand. And guess what? The exact same logic just works in reverse for a bearish order block. You're looking for that final gasp of buying, that last little green candle at the top, right before the bottom falls out. And again, the key is that massive red collapse right after. That sudden, aggressive selling is your proof that institutions dumped their positions right there. That green candle is the ceiling they created. So, you've found the footprint. You've marked the block on your chart. Now what do? You wait. You sit on your hands and you wait for the market to come back to you. This is the hardest part for most people: patience. This is what we call the return to source. You have to burn this idea into your brain. The market has a memory. These zones, these institutional order blocks, they are not random. They are significant levels that the price will often come back to test, sometimes hours, days, or even weeks later. Let's make this real. Let's say the micro S&P, the MES, is trading right here, right now, at 69.10. Okay? The amateur trader is staring at that number, just guessing where it's going next. But the professional doesn't guess. The professional asks a totally different question. They look left on their chart and they ask, where did the move that brought us all the way up to 6910, where did it start? They're hunting for the origin, the source. They're looking for that last red candle, maybe way back on the chart, that bullish order block where this whole rally was born. And here's the game plan. It's simple, but it's not easy. First, you mark the high and the low of that candle. That's your zone. Second, and this is the important part, you do absolutely nothing. You wait for the price to come back down into your zone. Third, when it gets there, you watch it. You look for a reaction, a bounce, any sign that those big buyers are still there defending their territory. And fourth, you place your stop loss just below the low of that block. If it breaks through that level, well, the institutions have packed up and left, and so should you. And that really brings us to the most critical takeaway here. It's more than a strategy. It's a fundamental shift in how you see the market. It's about going from being the prey to becoming the predator. So if you remember one thing, let it be this. Stop chasing the excitement of those big green candles. That's amateur hour. Instead, start methodically hunting for the footprints, the clues that are hidden in the red candles right before those big moves. That is where the real opportunity is waiting. So I'll leave you with this one question. Are you going to keep following the emotional crowd, buying the highs and selling the lows? Or are you going to start training your eyes to see the institutional footprints and trade right alongside the smart money? The choice is yours. I'll see you at the open.